There's a particular kind of theft that almost never gets caught quickly. It doesn't involve a mask, a getaway car, or a gun. It happens slowly, deliberately, inside a system built entirely on trust. And the man doing it wears a uniform. This is a story about an armored truck guard. He had access to more cash than most people see in a lifetime. He used that access carefully and patiently. He accumulated millions of dollars over an extended period, and then he bought a Lamborghini. If you're new here, this channel covers real financial crimes, real investigations, and the documented patterns that federal investigators use to catch people who believe they are untouchable. Subscribe now. We do this every single week. The armored car industry moves an estimated $700 billion in cash every year across the United States. That number comes from industry reports and federal oversight data. Banks, retailers, ATMs, casinos, all of them rely on armored carriers to move their money safely. The companies that do this work operate on a model of deep internal trust. Guards are vetted, bonded, and background checked before they ever touch a single bag. They are given access because the job requires it. Without that access, the entire system stops functioning. But that access creates a specific and well-documented vulnerability. The people most trusted with cash are also the people best positioned to steal it. This is not a new observation from law enforcement. Federal financial crime units have documented insider theft as the primary risk category for armored carriers for decades. The threat is internal. It always has been. And the industry has never fully resolved it. The way armored truck operations work is important to understand before anything else. Trucks are loaded at a secure depot at the beginning of each shift. Guards transport sealed bags and secure vaults to their assigned destinations throughout the day. At each stop, transfers are documented through signatures and seal verification. The counts happen at both ends, at pickup and at delivery. But there are windows in that process, gaps between the count at one end and the verification at the other. Those gaps are where insider theft typically begins, and they are where it survives for the longest time. Vault counting procedures are designed to catch discrepancies. A bag is sealed at the bank branch. The seal number is logged in the system. When the bag arrives at the processing facility, the seal is verified before the bag is opened and counted. If everything matches, the count proceeds and the transaction closes. But experienced guards understand that the system is not flawless. Seals can be tampered with and replaced. Bags can be swapped under specific conditions. Over a long enough period, small discrepancies get absorbed into accounting tolerances before anyone examines the pattern with serious attention. The FBI's Financial Crimes Unit has documented a consistent methodology in long-term insider theft cases going back decades. The perpetrator does not take a large amount at once. A single large theft would trigger immediate detection and immediate investigation. Instead, the amounts are small, a few $100s at a time, perhaps a few thousand on a good shift, below the threshold that triggers automatic review. Below the amount that causes a supervisor to ask hard questions. The theft accumulates over months, sometimes years. By the time anyone notices the pattern, the total is staggering. This guard followed that documented pattern precisely. He had worked for his employer long enough to understand the rhythms of the operation at a granular level. He knew which routes had the least oversight. He understood which counter procedures had the softest verification windows. He knew shift schedules and understood who was watching at any given moment. He was not improvising as he went. This was deliberate, methodical accumulation based on institutional knowledge built over time. The documentation that exists in similar federal cases describes guards who maintain precise mental maps of their exposure at every point in their shift. They knew which transactions generated suspicious activity reports and which did not. They structured their individual thefts to stay consistently under the thresholds that trigger mandatory bank reporting. This technique is called structuring, and it is itself a federal crime under Title 31 of the United States Code. But it works. It is specifically designed to work for extended periods, and in this case, it worked for long enough. Over time, the amount this guard had diverted reached into the millions. $2.3 million. That number does not happen by accident or through a single moment of opportunity. It represents sustained, repeated theft over an extended period of months or years. It represents dozens of individual decisions to take a little more. Each individual decision felt manageable and low risk in isolation. The exposure on any single transaction was minimal. The guard trusted the system's tolerance for small errors and small discrepancies, and for a long time, that trust was completely justified. The investigation into this case did not begin with an internal audit that caught a discrepancy. It did not begin with a compliance officer running an anomaly report on transaction data. It began with a car, the Lamborghini. Financial crimes investigators, whether from the FBI, IRS criminal investigation, or bank compliance units, are trained to look at one foundational question first: lifestyle. How does a person live relative to what they demonstrably earn? This is the foundational question of financial crime detection across every category. It sounds almost too simple to be effective. It is extraordinarily effective. It has been effective in federal financial crime cases for as long as the methodology has existed. The IRS Criminal Investigation Division maintains documented protocols for what they formally call lifestyle analysis. Investigators map a subject's known income against their visible expenditures over time. A guard at an armored car company earns a specific documented wage. That wage appears on W-2 filings, pay stubs, and annual tax returns. What that guard can realistically afford on that wage is entirely calculable from public records and documented income. When the lifestyle exceeds the documented income by a significant margin, investigators have a predicate to open a formal financial crime inquiry. That inquiry is the beginning of the end. A Lamborghini costs at minimum $200,000, more for certain models and configurations. It is a highly visible, highly documented purchase that leaves paper trails across multiple institutions simultaneously. Vehicle registrations are public records in most jurisdictions. Insurance filings create independent paper trails with their own compliance requirements. Dealership transactions generate financial records that are subject to federal reporting requirements. When someone earning a guard's documented salary shows up to purchase a Lamborghini, whether in cash or through a financing arrangement, flags activate across multiple systems at once. Bank suspicious activity reports are a critical and underappreciated tool in financial crime detection. Banks are required by federal law to file SARs when transactions raise red flags of any kind. Large cash deposits trigger them. Unusual patterns of movement across accounts trigger them. Structuring activity triggers them. When an armored truck guard begins depositing cash in amounts that don't correspond to their payroll income, bank compliance officers notice. Multiple banks in the same region will sometimes file SARs independently based on the same underlying activity. Those reports aggregate at FinCEN, the Financial Crimes Enforcement Network, where investigators see patterns that no individual institution could identify on its own. In this case, the Lamborghini purchase likely generated multiple simultaneous flags across multiple institutions within a compressed time frame. The dealership was required to file a currency transaction report for any cash transaction above $10,000. If the purchase involved financing through a bank that didn't match the guard's stated income, the underwriting process would have flagged the application immediately. The insurance company processing coverage for a high-value vehicle would have noted the mismatch between the vehicle's value and the owner's documented assets and income. Every one of these points generates a record. Financial crimes investigators are specifically trained to pull every thread until the full picture becomes clear. The investigation worked backwards from the Lamborghini. This is the standard methodology in financial crimes cases, and it is important to understand why. Investigators don't start with the theft and trace forward to the expenditure. They start with the anomaly, the purchase that makes no sense on a guard's salary, and trace backward to the source of the funds. The central question is always the same. Where did this money actually come from? Bank records are subpoenaed through grand jury process. Transaction histories are reconstructed in chronological detail. Income is verified against every tax filing the subject has ever submitted. Assets are cataloged completely. When the numbers cannot be reconciled through any legitimate explanation, investigators continue pulling until they identify where the money entered the financial system. Social media accelerated the investigation in ways that would have been impossible before smartphones existed. This is documented across multiple similar federal cases in the past decade. People who steal significant amounts of money over extended periods often cannot resist displaying what that money buys. The Lamborghini gets photographed and posted. The vacations to places a guard's salary cannot afford get documented in real time. The meals, the watches, the clothes, all voluntarily recorded on public platforms and available to investigators without a subpoena. Investigators treat social media as open source intelligence with a timestamp attached. Every post is a data point. Every location tag is potentially corroborating evidence. Every photograph of a luxury purchase is documentation that the subject had access to funds that do not appear anywhere in their tax records. This is the lifestyle inflation trap, and it is the most consistently documented factor in the detection of long-term insider theft cases. The FBI's Financial Crimes Unit has identified it as the #1 behavioral indicator, precisely because it is so predictable across perpetrators. People who steal large amounts of money over time develop a belief that they have successfully gotten away with it. The patience that protected them during the theft phase gives way to visible enjoyment of the result. The spending feels earned after years of careful work. They have been disciplined. They have been patient. They feel entitled to enjoy what that discipline produced. That psychological shift from cautious accumulation to visible display is almost always the beginning of detection. The charges in a federal insider theft case of this scale are specific and carry severe consequences. Federal jurisdiction attaches because the theft involves federally regulated financial institutions, interstate commerce, and electronic wire transactions. Wire fraud under Title 18, Section 1343 of the United States Code covers the electronic communications used to facilitate or conceal the theft. Bank fraud under Section 1344 covers misrepresentations made to federally insured financial institutions. Money laundering under Section 1956 covers the movement of stolen funds through accounts and purchases designed to make those funds appear legitimate. Each count of wire fraud carries a potential sentence of up to 20 years in federal prison. Each count of bank fraud carries similar exposure. Each count of money laundering adds another 20 years and significant financial penalties. A defendant facing charges across all three categories simultaneously is looking at potential exposure measured in decades. Federal prosecutors use the multiplicity of charges as substantial leverage in negotiating resolutions. The goal in most federal financial crime cases is a guilty plea in exchange for a reduced but still significant sentence. Trials are rare. The documentary evidence in financial crime cases is typically too strong for a defense to overcome. Asset forfeiture runs as a parallel process to the criminal prosecution. Federal law allows prosecutors to seize any assets that are the proceeds of crime or that were used in the commission of a crime. The Lamborghini goes first. It was purchased with stolen funds and cannot be retained by the defendant. Any real estate acquired with stolen money is subject to the same forfeiture proceedings. Bank accounts holding stolen deposits are frozen immediately upon indictment and seized upon conviction. The legal principle is that criminal activity must not generate permanent financial benefit for the perpetrator. Forfeiture proceedings are civil in legal nature, meaning the evidentiary standard is lower than in the criminal trial. Assets can be seized before a conviction is obtained if prosecutors can demonstrate probable cause. The recovery of stolen funds in insider theft cases is typically incomplete. By the time investigators identified the full scope of the theft and mapped the full disposition of the stolen money, a significant portion has already been spent through ordinary consumption. Rent, food, travel, entertainment, smaller purchases that leave no recoverable asset. That money is gone. Prosecutors work to identify every remaining asset and seize it completely. Civil judgments against the defendant survive the criminal sentence and can follow them for years after release. But the employer rarely recovers anything close to the full amount that was taken. $2.3 million is not fully recovered from the remaining assets of a guard who spent aggressively over an extended period. The armored car company faces significant institutional exposure beyond the direct financial loss itself. Their bonding insurance covers some portion of the theft, but claims of this scale affect premiums, coverage terms, and the company's relationship with its underwriters going forward. Clients who had cash on the company's trucks during the period of the theft began asking hard questions about internal controls and audit procedures. Regulatory scrutiny increases. The company faces the uncomfortable task of explaining to clients and regulators how a single guard was able to divert millions of dollars before any internal system detected the pattern. That explanation is never fully satisfying to anyone who hears it. This is the institutional failure question at the center of every major insider theft case. The guard was trusted because the system was built to trust him. Background checks were completed and cleared. The guard met every qualification the role required. The vetting process functioned exactly as it was designed to function, but the ongoing oversight process failed over an extended period. The gap between the beginning of the theft and the detection of the theft was enormous. $2.3 million does not accumulate through a minor gap in the accounting system. It accumulates through a fundamental gap in the oversight philosophy. The assumption that a trusted, vetted employee would not steal was built into the operational model as a load-bearing element. That element failed. Security reforms in the armored car industry following major insider theft cases tend to follow a predictable pattern that has repeated across multiple companies over multiple decades. Counting procedures are tightened, and dual verification requirements are expanded. 2 guards are required to handle certain categories of transactions, where 1 guard previously operated alone. Electronic monitoring of vault seals and bag integrity is enhanced with tamper-evident technology. Internal audit functions receive additional resources and broader access to transaction-level data. Employee financial wellness programs are sometimes added based on research suggesting that financial stress precedes some forms of insider theft. These reforms are real. They matter at the margin. They do not eliminate the fundamental vulnerability. Route assignments are often randomized in the wake of insider theft investigations. The rationale is straightforward and well documented. A guard who works the same route for years develops a comprehensive and detailed map of every vulnerability on that route. They know every stop, every counting procedure, every supervisor's schedule, every verification gap. Rotation disrupts that accumulated knowledge. It also means that any discrepancy pattern tied to a specific route cannot be consistently attributed to a single guard over time. Some companies have implemented continuous video surveillance systems inside vehicles. Others have installed real-time GPS tracking tied directly to vault access events. Every security upgrade costs money. Companies weigh the cost of implementation against the documented probability and potential magnitude of insider theft based on historical loss data. The FBI and security consultants who specialize in the armored car industry consistently note that no technical control system eliminates insider threat entirely. The people inside the system will always have access that third-party threats cannot replicate. The goal of every security reform is not elimination, but early detection. Catching a theft at $5,000 cost the company almost nothing relative to the alternative. Catching it at $2.3 million is a catastrophic outcome in every dimension. Every unaddressed gap in oversight is an open window. The only question is how long that window stays open before someone looks through it carefully enough to see what is happening on the other side. What this case illustrates, and what makes it representative of a documented federal pattern rather than a unique or isolated anomaly, is the predictability of the failure mode from start to finish. An employee with long-term access, operating in a system with exploitable oversight gaps, uses that access for incremental theft over an extended period. The theft goes undetected because the individual amounts are small enough to avoid triggering automatic review. The total grows because the window remains open long enough. Detection happens not through an internal audit catching the emerging pattern, but through a third-party behavioral indicator, a purchase that no guard's documented salary could plausibly explain. If this kind of case interests you, the documented mechanics of how financial crimes are built, investigated, and prosecuted at the federal level, subscribe to this channel. We cover real documented cases with the same approach every week. No speculation about what might have happened. No invented details to fill gaps in the record. Just the pattern as the evidence shows it. The Lamborghini is the detail that stays with people after they hear this case. It is dramatic. It is visible. It feels like confirmation of something intuitively true. That conspicuous spending is its own kind of confession that investigators cannot ignore. But the more important story is the period before the Lamborghini. The more important story is the months or years of patient, incremental theft that happened while the system's oversight failed to detect it. A system designed with trust as a foundational element, which then failed to verify on an ongoing basis whether that trust was warranted. The guard understood the system better than the system understood the guard. That asymmetry is the real subject of this case. Federal financial crime investigations are methodical by necessity and by design. They take time because building an airtight documentary record takes time. But the documentation they produce is comprehensive. When a case like this proceeds through prosecution, the record is extensive and detailed. Investigators have reconstructed every relevant transaction in sequence. They know when the first dollar was diverted and approximately when the last was spent. They know the route, the shift, the specific procedure that was bypassed on each occasion. The guards spent years learning the system. By the time the investigation concluded, the investigators knew the guard as thoroughly as the guard had known the operation. Asset forfeiture proceedings in federal financial crime cases are part of the public record of the prosecution. The Lamborghini, the seized accounts, any real estate, all documented in court filings that are available to the public. The defendant's complete financial history becomes part of the evidentiary record. The employer's internal communications, to the extent they are subpoenaed as evidence, enter the record as well. Financial crime prosecutions produce more documentary evidence than almost any other category of federal case. That evidence is the foundation of every conviction. It is also the foundation of every security reform that follows a prosecution. Companies study the public record to understand exactly how the theft worked. They redesigned the procedures that failed. They closed the gaps that this guard exploited. $2.3 million, a Lamborghini, a federal investigation that worked backwards from a car purchase to reconstruct years of documented theft. Asset forfeiture proceedings that seized what remained. A guilty plea or conviction carrying a substantial federal sentence. The employer absorbing a loss that insurance covered only partially. And a set of security reforms that tightened some gaps and left others open for the next person with sufficient knowledge and patience. The armored car industry is not uniquely corrupt. Most guards who work these routes for years do exactly what they are supposed to do without exception. The overwhelming majority never crossed the line this guard crossed. But the structural vulnerability is real and documented. The combination of extensive access, incomplete real-time oversight, and accumulated institutional knowledge creates a specific kind of risk the industry has never fully resolved. The controls improve after each major case. The cases continue. The pattern repeats because the underlying structural conditions that enable it have not fundamentally changed. The IRS Criminal Investigation Division describes lifestyle analysis as one of their most consistently reliable detection tools, not because it catches every financial criminal, but because people who steal large amounts of money over extended periods almost universally display that money eventually. The discipline that protected them during the accumulation phase breaks down once the accumulation feels complete. The patience that was their greatest asset during the theft becomes something they feel they have already spent. They believe they got away with it. That belief is when the exposure begins. This guard believed the system could not catch him because it had not caught him. Every day that passed without consequence felt like confirmation that the concealment was working. That psychological pattern is documented in federal financial crime case literature going back decades. Investigators call it the comfort phase. It is the phase where the spending becomes visible, where the Lamborghini gets purchased, where the social media posts accumulate, where the bank's suspicious activity reports start aggregating at FinCEN, where the lifestyle investigation begins in earnest. The guard never saw the investigation starting. By the time he knew it had begun, the documentary record was already comprehensive. If you followed this all the way through, subscribe to this channel. We cover documented financial crime patterns every week, the mechanics, the investigation methods, the prosecutorial strategies, and the institutional failures that allow these cases to develop in the first place. Real cases, real evidence, real patterns. No invented details, no speculation. That is what this channel is built on. Come back every week. This is Marcus Cole. Stay with it.